Hey there, everyone. Thanks for joining. We'll get started in just a minute here, but great to see everybody.
Hi there.
Hey guys, thanks for joining. John, good to see you again. How's it going?
Doing all right. Fully in board with 8 Best Help Angels, so that program is up and running at this point. So
Cool. That's great.
it's nice, yeah. Now we have to figure out how to do Barcelona.
Oh.
Yeah. Oh, yes.
That's an interesting one. My
Yes,
goodness.
we're going to do a transatlantic one too. So that's probably going to happen before Barcelona at the rate we're going.
That makes sense. Yeah.
We're knocking on doors trying to find, figure out measure the interest.
You ever work with the DLM guys about that?
I haven't worked with them on that topic, but I know those guys. I've been touching base with them for the last 5 or 6 years, even before when they were Startup Includer. I heard a rumor that Seed Invest is, sorry, not Seed Invest, Proseeder is coming to a close of some kind, and that DLM is really great. I don't know if that's true, but it sounds like there's a bit of a shuffle. There was a point at which everybody in Seattle was using Dust, and then all of a sudden everybody started using Proseeder, and now I see people jumping to DLM. I'm still an old fart Dust user.
What about Spark? What do you think about Spark out of the Tech Coast Angels?
Haven't used it, so I don't know.
It just had a demo. It was pretty interesting. It tries to network accelerators and angel groups together and then do syndication. It's got some member modules. It links out to Sarah for portfolio. It's got some basic work that's pretty interesting. It's got a cloud-based platform architecture. Interface looked pretty good. Looked pretty robust from what's going on. $300 a month, something like that. Is what they're charging, and like about 100 accelerators on it. So if you're into the accelerators, the angels, I think it's probably good there.
Is that the right one?
Yes, this is sparkxyz.io. Yeah, so that's the one.
Yeah, so there's a couple of things that I think we'll end up talking about today. So I'll hold that till get critical mass people.
Cool. We have a couple more people coming in. And so I don't know if you want to go around the room, everybody, introduce yourself. I know John, but maybe not everybody knows everybody, but I'll kick it off. And as we do the intros, we'll get a few more people coming in, and then we'll start dig into the content portion today. So my name's Hall Martin. I'm the CEO of 10 Capital. I think I know most of you guys, and we help startups and investors connect for funding. We do events and activities. We run a podcast program called Investor Connect. We have a startup funding espresso, that we promote as well. And we foster the entrepreneur ecosystems around the country. So we help angel groups find members, and we help startups find investors, et cetera. So we're working with a lot of different groups in that way. And I found that if we have events like these, we can really help foster best practices. You learn about new technologies, about new things, and you can take it back to your group. So that's what we do. Charles, why don't you introduce yourself?
Okay, I'm happy to be here. I've known Hall for quite a while. I vastly admire his efforts. I've been an angel since before the foundation of the Angel Capital Association in this country. I'm also a VC fund manager with a rather innovative new design, or improved and better design in my humble opinion. But I work in the early stage ecosystem, from early stage angel type deals all the way through VC and then Wall Street deals. I like to carry on with my successes. And I live in coastal Maine, where it's cold and snowy today. I admire all of you folks who live in warmer climes, so happy to be here.
Great, thanks. And Richard, you want to introduce yourself?
Yeah, sorry, I'm on mute. Yeah, Richard Samuelson, managing partner in Swan Venture Group. We have a high net worth fund operating. We'll be launching an institutional fund in Japan later this year, and delighted to be here. Thank you.
Great, thanks for joining. And Jigar?
you're on mute.
I think you're on mute, Jigar Modi. Yeah. While Jigar figures that out, Harjeet, you want to tell us about yourself?
Hey, Hall, thanks for hosting this. My name is Harjeet Singh. I run corporate and M&A strategy for one of the largest tech for equity platform for startups. So think of Y Combinator plus Accenture. We provide technology development services for equity. We have bookkeeping controller services to complement for startups. And we also do crowdfunding. We are looking at several acquisitions for this year. But in all, we have a team of about 700 people within the organization.
Great. Thanks, Harjeet. And Sylvia, you want to introduce yourself?
Yeah, hello, hi. I'm Silvia Mella, and I'm the founder of Soratem. It's a Japanese green tea and matcha brand. We only sell online through a subscription model. We are starting introducing some B2B now through some coffee shop and stores. We did a soft launch about 2 years ago, raising a little bit of capital of like 70K. So it's really organic now, and we are going to do our first seed round soon.
Okay, thanks. So let's go back to the group, and as we get more people coming in, we'll be able to post more questions up here. But John, what question did you want to post to the group and as a discussion point?
Well, so let me talk a little bit about what Seattle Angel Conference is and what the Seattle Startup Investor Accelerator program is, and then put it in that context. So I'm earlier than all angel groups in the sense that I create new angels by teaching people in their first investment. So I have a deal flow question around getting startups that are in the pre-seed area, but I also have a deal flow question about getting investors, because my goal is to get people who have never invested but are accredited to write their first check. So I'm always aiming for, how do I get 20 new people each cycle? I get 40 people, 20 have done it before, 20 haven't done it before. So there's no go to LinkedIn and search for people who say, I want to be an angel investor. They are one or they're not listed, right? And so I have a double-sided market problem. And so from the deal flow point of view for startups, I had some great success recently with using Gust to send a private message to very specific companies. We did a search and tuned down, their interface doesn't do enough tightness on that, but it allows, they can do it by reaching in the back end. So they sent out about 500 messages, and boom, in 3 days, we had 50 companies in our pipeline that are all pretty much useful, right? There's like 2 or 3 out of the 50 that are troublesome. They're not really ready for what we're talking about, but for the most part, good companies coming in. I can't figure out how to do that for investors who are not yet investors. I don't know where there's a pile of angel wannabes, essentially, that I could send messages to. And so my question on one side is, what do you think about using the platforms like Gust and F6S and Dealom as a mechanism to get deal flow for startups? And what would you then propose would be equivalent for investor wannabes?
Great. Anybody here want to take a shot at that? How do you find angel investors or potential investors for your group?
So look, pandemic has been as disgusting as it is, but it's also been a blessing in a lot of ways, right? I'm on the board of an organization called New York TIE. TIE is the largest non-for-profit organization in the world. We have 62 chapters in 14 countries. We have 3,000 angels. The interesting thing is, in order to vet deals, we have our own platform. Gust is great. I love Gust because I use it for Kiwi Tech. It helps. If a local chapters within TIE invest $100,000, then it goes to the global platform. And last year we did 2 deals, and each of these deals, we had over $1 million in commitments, right? So how do you get there, right? So now I'm in the middle of putting together something called, if you look at a company like Disney or others, see, Hollywood and Bollywood in India, it's only to the handful few. They control it. If you want to invest in Milan, you can't, right? So I am and this is personally, right? Because I am interested in media, the amount of media my kids consume and others. I want them to say, okay, if it's Pokemon, the next movie is coming out, we invest $5,000. We have access to investing as a crowdfunding investors and access to the movie and the merchandise. And if we go to the theater, the ticket is cheap, right? So the way I figure this out, look, in order to raise money for these IPs, when you figure this out, is how do you take down the risk? And you have to bring on people. The first $100,000 is the hardest. As an angel investor, when you have $100,000 in commitment, you should pat yourself on the back. That's a good deal, right? For a group that's starting off, right? In New York, we had always had difficulties getting to $100,000. So we have like 80 members, and some of them are capable of writing $250,000, $500,000 type of checks. So what we did basically is, because we have an existing member base, hey, look, we are going to invest. This is the company we did due diligence. I am going to write a personal check, and we know who all these people are. And we wrote something called an investment summary these are the 5 companies that pitched on a monthly basis, 5 different companies. So you have like 60 companies, and you take down the best one and you write an investment summary and you share it with the crowd. Then the people who are interested, people are interested in health tech, fintech, you'll figure this out very quickly. They'll start replying to you, hey, I'm only interested in media tech, advertising, others. So you start building up on those, saying, okay, I'm only going to share. You don't want to, even though you can share these deals, you want to be very particular in terms of the inbox, right? You want to respect their emails. So once you know what your global, or your whole group is looking for, then you know, hey, I have a deal. I'm going to write a $20,000, $25,000 check. Would you like to come in? That's how you start building up. You get one, then look, in order to do deals, you got to get a couple done, right? And we got a couple done. Now our member has doubled member base, and Hall has presented to our member base in the past, right? We get some of the events that we get, like I'm just talking about within the thing. Mostly Thai is known for an Indian, even though it's open to everybody, but a lot of Indians out there. And now we're starting to say, hey, we want to write checks. So now the conversation started because we are showing them deal flow. That's my take.
So I'm not clear how that helps me with the angel investor who doesn't yet angel invest. That works fine for syndication among people that have clicked in their mind that I'm an angel investor, give me a deal, it'll move me forward. But how about the person maybe even in Thai who is accredited, of which, all of the doctors that have worked for 2 years are accredited. More than 50% of the tech people that are writing code in Seattle are accredited. 0 of them are writing checks. So how do I reach them? What's the deal flow mechanism for them? And then carry that forward.
Just to finish my thought, I think education seminar has helped a lot. I think Kretsu does that. I believe Charles Sidman is part of, from where I met him last, he's part of Kretsu. You have to create a lot of education seminars, right? For people to say, okay, one is trust. You have to create that trust. Education seminars has helped us for people to understand why invest, why angel investing. You have to give them stats. And I think people will start coming forward, but that's the way we have built the ecosystem here in New York in terms of Thai.
Cool. Charles, what are your thoughts there?
Okay, I take a different view of it from Harjit with respect. I don't believe that everybody who's accredited should be expected to or finds it wise to do angel investing themselves. I'm a big believer that if they have portfolios and want to retire comfortably and leave money to their children and grandchildren and all that stuff, they should have exposure to this asset class. It's a wonderful asset class for the investors, and it's important for the world and all that. So we're totally on the same page there. But I believe from my experience that it takes a substantial amount of education, yes, and then continuous application and effort to do it well. So I want to make a comparison. One of the things I've done in my life is sit at the controls of airplanes. I'm a flight instructor as well as an investor. And I know, because I've done it many times, I can teach anybody on this call, or practically anybody who can walk through a door without hurting themselves, to fly an airplane. and I can teach them how to fly from Maine to Texas and Texas to California. And, I've done that. But should all of us become pilots? I don't believe so. Most of us are better served by hopping on a Delta jet or an American jet and letting someone fly us where we want to go. Because if you want to do it yourself, you've got to spend a lot of money, and you do in the angel world. You have to spend a lot of time, and you have to spend a lot of continuous application. It's not something you can do for a week or two and then go away and do something else and take a long vacation. You've got to do it continuously. And for those who want to, I'm here, I'm available, I respect them, I'm a fellow, but I don't think most people have that singular dedication and focus. And so my fund is organized to serve those doctors that John talks about, who want to be doctors, not investors. They should have exposure to this, but they shouldn't be expected to do it, because if they do it poorly, they're just going to lose money. And that's what most angels do. I've seen group after group after group take in investors. They do it for a few years, 5 years, 7 years, whatever, and they wander away disappointed because they didn't put continuous effort into what is a long-term activity. When I teach someone to fly, I, as the flight instructor, am not allowed to let them into the air at the solo controls until I am sure, and I'm at the side of the airfield watching, sweating bullets when my newbie pilot goes up and hopefully comes back. We're launching all these angel investors into the air, and that's okay, I guess, because they're not going to lose their lives. They're only going to lose their money. But I don't expect that every doctor and dentist and airline pilot should be an angel investor. Those who want to, that's great. But most of them, I think, are better served and realistically served by investing through a fund. So,
Great.
Paul, you asked for 2 cents, you got 3.
That's great. What do you think about that, John?
Well, I agree that not everybody, but I wasn't saying anything about everybody. I was simply saying 99% of the people that are accredited don't write checks. There's 10% of the US population that could write checks, and surely more than 1% would benefit from being in this asset class and to be leaders in this asset class. And I agree, there's a bunch of people that ought to be limited partners in some kind of fund to get exposure to some kind of asset class. And I believe that pre-seed, seed, and Series A are really fundamentally different asset classes. So I'm being a little bit picky about that set of words. But I think that there's a significant number of people that need to understand the space. And one of the best ways to understand the space is to do one. And so Jigar, if his audio would work, is one of my alumni at Seattle Angel Conference. Apparently he's moving to Austin, wants to learn more about you, Hall.
Cool.
But he's been chatting in the chat with me. And so I think that we should have, the early adopters at least, right? We should be able to get to 2 to 5% of the accredited people doing something active with angel investing in a meaningful way. Lead investors are different than fund managers, are different than active angels, are different than passive angels, are different than LPs, right? And so you have to find your space that works for you as a person with your personal thesis about this asset class. And if you have no exposure to the asset class, you can't develop a thesis. And so my program is about developing that thesis. And I'm back to the marketing question. Of the 30 million people in the United States that could be writing a check, how do I find the ones that are on the leading edge of interested?
Great. And so Mark Schwartzberg, you joined us today. Mark, did you have any comments there and you want to introduce yourself?
Yeah, sure. Nice to meet everyone. I'm investing, we're more of like a family office style thing. I think as far as bringing on outside LPs, it probably sounds more of like a marketing play than like a traditional sales play. So if your strategy is just emailing, that definitely works from a founder's perspective. But I think you see these other kind of like Republic and all of these other kind of companies that are developing, they're crushing just through kind of marketing. So I think if your goal is to bring on accredited investors or there's another company, Israeli-based company, micro something.
Micro ventures.
Micro ventures, yeah, they're crushing too. So if like the goal is just to bring on accredited investors, I would definitely go down that path as opposed to trying to email and guess like who's accredited, who's not. I think just trying to like get on radio, like get on, Facebook, get on everything that you can. I have no idea if that's legal or not, but that seems to be. So it seems to be like working really well.
Reg D 506C, it's perfectly legal.
Got it. So yeah, I would come up with a strategy like that. That's the path I would go down. And then as far as my deal flow goes, I also am just shooting emails out to interesting companies, which is working like very well. And then I worked at Techstars for a few years, so I have kind of natural deal flow from that front. And just always networking and meeting with people, which are telling everyone, hey, send me some interesting companies.
Cool.
So just to add what Mark was saying, look, in the I know Charles have a question, but quick input. In the month of January, there has been $24 million raised in crowdfunding. WeFunder and Start Engine were the leading, and the reason is they are able to market. They have their own marketing capabilities. And look, if you go to AngelList, look at how many angel lists are there, how many checks are there, money being written. There is checks being written like every day for every deal, but it all depends on, like, in my opinion, I say this to you again, how do you get people to write checks? Look, everybody has different expertise. I like media, fintech, health tech. These are the businesses I believe it, right? Or now the second coming of web coming, right? This is the best time to buy it, right? So that's depends on which hat you want to put on and where you want to beat your drum. That's where you're going to most get interest, right? Meaning, in my opinion.
Yeah. And also, like there's other platforms, like you mentioned, AngelList. I have friends that are on there that run syndicates, and the strategy there, it's like social media, right? Where you'll partner, you'll just share a deal with another syndicate and ask for a shout out. And like I've talked to multiple syndicates. Everyone on there has a couple thousand LPs behind them, and they're all the same LPs. So you just partner with one of the top or two of the top because you're bringing in one good deal, and then you just have a good thesis behind you. You'll automatically get like 100+ people applying to your syndicate, and just keep doing that and turning the crank.
So help me, Mark, understand. I have a fanatical belief that angel investing without due diligence is just plain stupid. And so when you have a syndicate where you social medialize and wave your hand and do blah, 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 and you don't do due diligence on that, how do you think that is? Is that a good thing?
Total. So let me, just to clarify, that's not what I was saying. I meant, like, let's say you find a really awesome company that you perform due diligence on. You could go to an active syndicate and say, hey, look, I found this company. And what works on AngelList is different than other places. So they'll usually look for like there to be a lead investor, someone that kind of has proven that probably has done the due diligence, right? And so if you can, and you might have like an allocation towards that for a variety of reasons. So you go to them and say, hey, look, I know this company, et cetera. And then you partner with them, they give you a shout out, and that just builds your LP network. I think in certain cases, I mean, like as an LP, you're not doing due diligence on these companies either. You're relying on someone. So I think where we're at in this market, inevitably there has to be some, you can't do due diligence on every company if you want to write enough checks, if you want to write, like VCs, huge VCs have admitted that, they're allocating at least 5% as write-offs because they're scams. Like the literal assumption, the market's so fast and it's so virtual and it's just literally happening from 1 to 2 phone calls. Everyone is, if you're writing 100+ checks, you almost have to assume that at least a percentage are going to be, straight up scams.
I think that's an interesting question to explore. How many checks should I, as a modest angel, be writing? Not a regular super angel, but a modest angel. How many checks should I be writing? And what percentage of my net worth should I be dropping into this asset class to sort of frame that statement? You just said you can't do due diligence on enough companies to get to the volume you need to be successful. What do you think that is?
I could make up an answer, but the real answer is like, it just depends on kind of like what companies you're investing in. I mean, you if you're saying I know people that like I have a buddy who's a lawyer, and he's been in the market. He'll write like small checks, and then he'll act as a lawyer for them, and so he recoups a lot of that investment. So that's like one
Yeah,
strategy.
That's cheating. That's cheating.
Right,
And not only is that cheating, that's troublesome in a couple of other ways. But so statistically, running the what is it, Monte Carlo simulations on our theories and so forth, we know that following the expectations of what most angel groups are seeing and what early stage VCs are seeing is we need to be in at least 20 deals for us to have a reasonable chance that we're going to hit one of the big ones that will return the fund plus, right? And the more that I look at it for pre-seed and seed, so 80% of people who are accredited are below 5 million in net worth. And so my little magic equation is 10% of your net worth into angel investing, spread that off across enough deals for it to be useful so that you get more money so you can put more money back in later at a different level. So if I need to be in 20, that means that most people that we talk to need to be investing pre-seed. They should not be writing seed checks unless they're part of a fund like what Charles is saying, where you have enough volume to be useful at the seed level. So we're writing small, $5,000, $10,000 checks. We're not writing $50,000 checks because it breaks the equation to write a $50K check if I'm a $5 million.
Where are the companies based that you're investing into?
Right now, because of COVID, we're North America, and I'm working on a transatlantic angel conference. So we'll try to figure out how to invest in Europe. That's sort of the next part of the growth program. But so I think for seed and pre-seed companies, you need to be investing in breadth, not depth. So if I'm 5 million in net worth, I should be writing, the 40, 60, 5K checks rather than writing the 20, 25K checks, right? I have a better chance of building a portfolio that's going to give me a reasonable return with that.
Totally agree.
I also at Series A, I shouldn't be thinking about follow-on either. And that's where the funds that Charles is talking about really pay off, is if I come in at pre-seed and I come in at seed and I come in at Series A, then my follow-on strategy can work. But if I'm just staying at pre-seed, follow-on is a bad idea.
Great. Charles, did you want to add to what you wrote in the chat?
Yeah, I don't think John's strategy is really feasible. I don't think putting 10% of one's net worth into this asset class right from the get-go is wise. You have to build up to that. I'm much higher than that now, but I've been doing it for a while and, growing it through this asset class. But, you're right. You got to have at least 20 investments, but then remember critically, you have to follow them and you have to be at the table and protect your turf because people are going to try to take away your cookies all the time. It happens just so often. We don't talk about this. You got to be ready to fight for what's yours, and you got to have the resources to invest further. Most of my deals, and all the successful ones, I've invested multiple times because in those later rounds, those who don't reinvest get squashed just by that process. So, you're right about the 20 plus companies, but you invest in 20 or 40 companies and follow them through and have to be ready to act, within days or weeks when things come up in further rounds. And that's what I find unrealistic.
So understand that I'm not talking about individuals writing individual 5K checks. I'm talking about groups of individuals forming a group where the group assigns a manager to do that follow-on work or following task. And so I agree with you that if you're not paying attention to your investments, you're going to get squashed. But we do that through creating the syndicates where somebody has responsibility. And Mark is right that following 40 companies aggressively is a full-time job plus. And so you have to spread this out. So if I have 40 people and we invest in 40 companies and we each take one company that we're responsible for and we hound for it, that's a different kind of task than me writing 40 5K checks and then trying to herd 40 companies, right?
Right.
So,
Well,
so
if you can
below
do
5
it,
million, I think that it's necessary for you to be part of a syndicate, a group of some form or flavor, where you together, not a network, but a fund group, where you put the money all together and you decide all together and you support all together. And without that, you get exactly what you're talking about. You get this inability to defend your turf.
Great.
well, I guess the assumption there then is that you can find 40 people that you trust as much as you trust yourself. I'm not sure I found those 40 in my life.
Great.
Yeah.
So thanks, guys. Elizabeth, did you have a comment you wanted to make? Want to introduce yourself and give us your take on this topic of how do you find angel investors who are not yet angels?
My name is Elizabeth Cross-Nicola, and I actually work with John Seacrest. And
Oh, okay.
we've met beforehand on some of John's sessions. So actually, it's interesting because we're just standing up Apis Health Angels, and we have had these questions on how do you find people who want to come along and join with you, and at what stage. We're an education program, so do they come in and stay for the whole time, or can you structure a way that they can piggyback along with you in a passive role?
Great. And Robert, you haven't had a chance to talk yet. Just want to give you a shot at this. If you'd like to share something about this topic.
Yeah, thanks, Paul. Can everybody hear me? I'm in a car in a parking lot.
Yeah, hear you fine. Go ahead.
Okay, but I'm not driving, just so you. Yeah. I really appreciate the comments that everybody made. I found that the WeFunder investors are emotional investors, not financial investors. They're investing based on your relationship, small dollars. Most of them are first-time investors. It's more of a WeFund, GoFundMe crowd than they are an angel crowd, to be fair. And I agree. I can't remember the name of the person who said that first $100,000 is really hard. We hit a wall, and that's when we called Hall to kind of move beyond that wall, because WeFunder does almost nothing for you in that first 100,000. They send one email out that went out to their quote 1 million investors, which aren't really investors. And out of the 1 million people that got that email, we had 53 click through and 6 invest. So that's really a pitiful response rate in any click-through type of technology that we have today. So what we found in that crowd is we spent an enormous amount of time educating people on what investing is, not just crowdfunding investing, but what is investing? And most of them said, I don't care about that. I like you. I'm going to write you a check for $100 or $500 or $1,000. And so to go from the friends and family crowdsourcing WeFunder with really almost zero support, we found we were just spending an enormous amount of time educating and getting a $100 check for it. So it's a slog. And so I've also done angel investing, so I'm somewhat familiar with that space too. I agree that breadth versus depth is probably more of a place of a small angel investor or very modest angel investor. So I've really appreciated your comments. I really like sort of the parameters. You really want a portfolio, sort of 20, hoping the one big one will pay off. So it's a portfolio play rather than individual company play. And anyway, I really appreciate everybody's comments. I'm fully on board with what everybody said.
Great. Thanks. And we have Catherine Rhee as well. Catherine, did you want to chime in at this point?
Unmute.
He's in space.
Yeah, it looks like it. Yeah. Well,
I think that's Star Wars.
Well, I like to chime in myself, and we do have a few other questions I'd like to get to. Is we reach out regularly on behalf of angel groups to help find angel members, and we use LinkedIn Helper, And my experience is on a mailer, I'll get about 100 responses. They're clicking, they're connecting, they're doing whatever. And out of that, I'll get 5 to 10 that say, I'm interested in angel investing. And out of that, I get 1 to 3 signing up at the end of the day, because they come in, they talk, they find out what the group's about. The time commitment is really the issue. Not everybody has that much time. But from the outside world, angel is investing is a very opaque, murky water group. We have no idea what goes on back there. Even when we get into the groups and learn about term sheets, we really don't have a good sense of how this thing works. It's voodoo, mystery, and magic. And so that's why a lot of people do. So when you see that, 1 to 3% of the investors are angels, I think you have to live with that just because of the dynamics of angel investing. You're going to get 1 to 3%. So you're going to have to cast the net pretty wide. I did find about 10 to 20% were signing up for syndication platforms where I can join and just invest on behind the lead investor that's up there. Seen that in angel groups. A guy says, I'll lead this deal. I'll put the first 250 in. Boom, we're at 1.5 million in a heartbeat because there's a lead investor who's going to take the work on. And so that's the dynamic that you can promote a lot with syndicates, is that come in and we'll lead the deal, and then you decide if you want to join or not. Your choice. That's a challenge with funds, is people don't want to be in every deal. They want to be in specific deals, and syndicates let you do that as well. So I look at from a numbers point of view. The thing I'm seeing come up now is kind of interesting, is I'm getting calls from people around the country. I'm an angel investor in my local chapter, but I'm looking around the country to see which group I want to join, because it's now all online. It's Zoom. I don't have to go to the best group in my city. I can go to the best group in the country, and they're looking at, what sector are you in? Do you write checks? Do you have a track record of does the group have a track record, and so forth? So I go on LinkedIn and promote the idea of startup investing and put out there a lot of those metrics, why they should come and join your group, because people are wanting to do startup investing. They just don't want to do all the work by themselves, and they're getting more and more specific about what they want to invest in, impact and other things. And I think we'll start seeing people shift their membership from one group to the next, because they have many more choices up there. So you have to be competitive in that case.
Would you do me a favor and tag me on those posts, and I'll be glad to join into a voracious LinkedIn conversation about why what you said was great or terrible, and we can spread the width of that.
Sure. Happy to do that. You can see what we're doing out there with different groups and so forth. People love the idea of follow-on investing because they're more retail investors. I just want to punch money in and have somebody else take care of it. I think ideally they sit down at a website that looks kind of like your discount brokerage and let me put 5 here and 10 there and move money around. And so that's where it's going, but it's not quite there yet. And
do you think our crowd does that well?
I think so. I think, they do have a bit of a complicated structure on each deal. So there is a fair amount of paperwork on the back end of that thing. I'm not sure everybody's signing up for all the paperwork that goes with our crowd stuff. But anyway, I've heard about that. But the idea was, if you make it easy to invest, you make it, there's someone that knows the deal and they're leading it, or they're supporting it, or the group's got a track record. We all come together, we're successful. I think that attracts more people. And I suspect we're going to have 10, 20 angel groups really come up and be super angel groups, because they really are providing the service a retail investor wants. And those who want to just go to the local group can still do that for the social and the networking and support the local economy. Those are the usual reasons they do that. Those will still be there, but they'll still be the 50, 60 person groups. They won't be the 500 or 1,000 member groups, because a lot of groups are on their way up to 500. Venture South, Tech Coast Angels, they're well on their way up that curve, but they're offering all those services that come into it. So it's really robust, but we can talk more about that as well.
When you use the word retail investor, you're saying a retail angel investor, and they behave different than other kinds of angel investors. Can you go into that difference that you're articulating a little bit tighter?
Oh, the idea, I said the guys that went into the angel group were the ones that wanted to do true angel investing. I want to get in there and make my own decisions and diligence it and learn the process. That's a skill they want. The retail investor is the guy that wants to invest in startups, but they really don't want to spend the time to learn how to do the term sheet. And I'm diversifying my portfolio. I want, 5% to be in startups. How do I get in there? Don't want to be in a fund. The fees are too high. I just can't swallow that. And so I want to go make direct investments, but I don't have a huge amount of time. So how do I do that? And so either syndicate platforms or angel groups are one way that the retail investor gets to join in and actually put in money into startups, get exposure to that world for what percent they want to do. Can be fun to go work with other guys, learn a little bit about the space, but they're really not professionals in this. They've got a day job. It's 70 hours already. So I really don't have a lot of hours left to spend on angel investing. So I looked at them as the retail investor. People used to walk in with $1 million and they, spread 100K checks around to get their 10 investments. Now they walk in with 100K and they want to spread the money around to get 10 investments. So they're investing 5 and 10K on the first round. So it's just the money's different a little than it used to be in that case. We did have a couple of other questions we want to go through. Anybody want to have any closing comments on that we close that one out?
Go ahead, Sylvia.
I would like to ask, how do you guys feel as a angel investor about a safe agreement?
How do we feel about a safe agreement? From my side, I think safe is very commonly used. It's very easy to get into for the initial round. It's a good way to kick it off. It doesn't have a lot of covenants in it. It doesn't have a lot of protections in it, and it can be tough. But at the same time, the very, very, very early stage, that's one way to start off the deal. We also see convertible notes. Anybody else have comments on safes?
So we don't like safes because they don't have a hook in them to cause the company to come back to the table and have a conversation. They just sort of launch it off into space, and then where it goes is where it goes. And that's perfectly fine for Y Combinator, but it's terrible for the local angel investor who needs to be in conversation with the startup who is not yet doing what they need to do to be getting the next round. Only 10% of the deals last year were safes, so they're not totally common, like you said. I think that they are perhaps talked about a lot, and there's some big players that do them loudly. But most of the deals are convertible notes at the early stages still. The convertible notes are a pain in the tuchus because they cause tax events that we would prefer not to. So there's definitely improvement to safes and improvement to convertible notes that are possible. So our current state of affairs is that all of those agreements suck in one way or another, and we need to make them better. But if you come into the Seattle market, the chances are that they won't let you do a safe. They will adjust the terms of the safe so it looks a lot like a convertible note and then call it a safe.
Yeah, okay.
Cool. I had a question from another group here. How has deal flow sourcing changed in a post-pandemic world? What are the new barriers? Let's use that as our next question and see what you guys think about that. Now that we're in a post-COVID world in hybrid mode in most angel groups, how do you see the deal flow changing? Are you getting deal flow from out of the area? Are you getting things shot at you from all different directions, or are you finding it less? Anybody want to kick off with that?
Our deal flow has certainly gone up. The quality of our deal flow has gone up, and it's been very interesting. We say North America. We haven't had any Mexican companies yet, but we have a growing number of Canadian companies. The Northeast has a significant number of interesting companies that have been finding us, and I'm not sure why and how they're finding us, but really good companies coming through. And again, the note that we got from Gust to our folks for APIS was really quite helpful. And so where the online marketing channels are, you can produce a lot of companies coming in that are at a more tuned level than before. And I suspect that F6S will do the same thing. I have a meeting with them this week, so I'm going to try and do the same thing with them. And so I think that it changes your marketing dramatically. Somehow you have to be available in their mind, and Seattle Angel is not in the mind of most people in New York. So it takes a little bit of marketing somehow, which means that we're marketing against all 700 other angel groups, which has its own set of problems. So I think that's why the syndication stuff that Kretsu's doing is useful. I think Kretsu's a little bit far upstream for where we're investing. So I think there's another syndication among people at the pre-seed level that's probably worth figuring out where that's at.
Cool. Any other thoughts out there, guys?
I think that oftentimes you're finding that there's some specialization, and so people are finding out, even if, like, we're special for health, and so people are coming to us, but even within some of our health companies that applied to us, they actually have tried deals with Golden Seeds. And so they were moved from one chapter to another chapter to another chapter, so that someone said, oh, we think we need expertise in this to evaluate. So there was more sharing. But it also means, I think we found that some of the companies pop up in 2 or 3 different places. And in fact, in our APIS, we actually have 4 companies that also were shortlisted in another angel conference running around the same time. And so they're, once they get on the circuit of this, I think it seems to me that they're wandering to all the people who looks like they might apply to.
That's a good point. Any other experience out there with deal flow in the post-pandemic world? I'm part of the Baylor Angel Network, and we used to have people drive in or fly in from all over the country to go do pitches. They fly into Dallas and drive down to Waco. Today, I think almost all of them simply Zoom in. They're not there in person anymore. And so you really don't get to meet people face to face. You get a 30-minute Zoom pitch at Q&A, and then that's it. So I think it changes the dynamic a little bit, but you do get access to more investors.
Paul, I have a question, if I may.
Sure.
How does the angel investor community play with the Reg CF unaccredited investor and SAFE world? Do they play nicely on the same field, or do angel investors not want to play in that same field?
I'll take a first pass, but looking forward to other people in the room. Harjeet, whatever you guys want to say. I find if it's a quality deal with a reasonable valuation, I think they play very well with it. The challenge I've seen angels have with Reg CF is we get deals with 50K of revenue and a $50 million valuation on it, because no market reality was ever applied to it at the CF level. At the angel VC level, no angel or VC is going to write you a check for an out of bounds valuation, and so market reality gets baked into it. So I think it's primarily that. I think early on there was some concern about Reg CF messing up the cap table and so forth. I think that stuff pretty well is gone now. People realize it's it's just one entity on the cap table as well. It's the valuation that really messes it around. Who else has a thought about that?
Harjeet, do you have a thought? Yeah.
So we have an in-house crowdfunding marketing agency. So give you a little bit of a background. We have 550 startups where we have an equity stake. We develop their technologies. We own anywhere from 2 to 10% of the company. Then we have finance and accounting company, which has 100 venture-backed investors like Google, Bessemer, NEA. On the third side, obviously, crowdfunding marketing is a business that's taken off. So I think I agree with a lot of that. Hall has said that, look, it all comes down to evaluation. But think of a couple of things. What has changed? Bank Mercury, which is an online bank for startup entrepreneurs, Andres Horowitz was their lead check writer, right? But they went to their startup entrepreneurs who backed with them. They raised $5 million. Look, you're the community that we want to serve. We are growing. We want you to, make money and be part with us. This is a company that we want you to be part of. So think of some of these traditional business models. A Republic Bank serves to startup entrepreneurs, and Signature Bank, and a lot of other banks do it, but not as a way they model their mission statement that they cater up to startup entrepreneurs and startup funds. Republic has like 500 funds. So now, guess what? These, Brex has done what Bank Mercury has done. They have taken a lot of that, going towards startup entrepreneurs. They have changed the strategy. Same terms, right? It's just you can't have somebody who's investing $500 to sit on the board of, Bank Mercury, but Anderson Horowitz does. But you're investing at the same terms. Even if the valuation is pumped 25, 30%. I would still invest with them, right? Meaning in terms of Anderson Horowitz is not going to invest into a company if the company is not going to go public, or they don't think, it can go and they can make X on their deal, right? Or go bust. So a lot of that is in terms of depending on who you raise money, it's important. That's when I said, look, I have a special interest in media angels because that's a space that has not, there's advertising, a lot of other media deals that has been, field has been conquered, but investing into intellectual property hasn't been conquered. So I'm doing some due diligence is how do I, where I will write, 6-figure check, I'll be the first $100,000 check. I'll invest 4 or 5 investors who will put in $100,000 each or more money. So when there's $400,000, $500,000 raised for like a series like Pokemon, Milan, other, these companies like Disney and others, they have a monopoly on that field. How do you build a product like investing angel round, seed round, Series A for an intellectual property, right? So if we are the largest check writer, I want to have about 5,000 angels in that network. They have access. Why? We all have kids. They consume the same amount of content, but they get to invest into what they really want to watch, the content they want to watch. And, I am something like my kids, they play Roblox. So guess what? Roblox is down to 70. I have bought both of my kids shares in that company. So something along those lines, I think crowdfunding marketing is here to stay for great businesses evaluation. It's only going to go big. Just look at the numbers, right? Meaning $24 million. It went from $1 million to $5 million last March. I seen crowdfunding marketing agency. There were only used to be 7 crowdfunding marketing agency. In the last 8 months, now there's almost 72 to 73. There were about 67 crowdfunding marketing platforms. Now you're looking at about 125 crowdfunding marketing, Reg CF platform. I am very involved in the industries, knows all the key players and where the money is coming from. And I'm very excited. Look, not everybody is venture investable. Not everybody is angel investable, but that shouldn't stop you from raising money. If you think your business is generating your revenue, there's a way to make money and you have people who believe in you, you should raise money through crowdfunding.
That's a good point. Any other thoughts there?
Yeah, crowdfunding, when we look at the rate of growth of the companies that we could invest in, there's a very narrow kind of company that can do venture. And there's a wider range of companies that can do angel. And there's a wider range of companies that can do crowdfunding, right? It changes, right? And so even though I'm doing crowdfunding doesn't mean that I'm right for angel, nor does it mean I'm right for venture, right? And there's layers in this pie. But there's a particular layer that I think is particularly interesting, which is a modestly scalable company, which might be angel one and done kind of thing, where the proof of the market is in the crowdfunding, where the audience who's buying the product wants to be part of it, as Harjeet was saying, but where the due diligence was done by the angels that are coming in onto the crowdfunding deal. So WeFunder supports this pretty directly to have a lead investor that's an angel that's sort of representing the due diligence part of this. And so I think there's an amplifier that's possible for that slice of business. The difficulty is that most companies can't tell you which layer they're in. And so they think that they're venture fundable all the time, when in fact they're probably in a different layer. And so the question is, how do you characterize the company to know where they are in their ability to deliver on revenue and growth, right?
Right.
So revenue redemption, for example, is one of those things that I think is a perfectly good angel investment strategy that will actually play nicely with crowdfunding, that will expand very widely the number of companies that can get funded by outside funders in a profitable way for everyone involved. But you have to understand what that means to the business and what kinds of businesses can do that and which kinds can't. And the businesses that can't manage margin can't play in revenue redemption, right? It's just important. You either invest in growth or you invest in margin. And those are the two components, right? Or you invest by feelings, which is a third market that I don't play in.
Right. That's a good point. I once was told that investors move up and to the right over time. They move to bigger dollars and they move to later stage deals. In post-pandemic, I read a Twitter tweet that said, private equity is the new hedge fund. VCs are the new private equity. Angels are the new VCs. and crowdfunders are the new angels. So in the long term, I think that's the direction it goes. It may not be there now, but it's going that the new early stage seed will be done by crowdfunding. Angels, I see getting more professional all the time with later stage, more sophisticated term sheets, tighter terms, stronger valuations. And VCs are in a very unusual place where Sequoia is now a private equity fund, and some are venture studio models, or they're going in different directions. But that's kind of where it goes. It goes up and to the right, and we're just on the curve there. Remember back in the 90s, angels were we're treated like crowdfunders. VCs said they don't know what they're doing. They're going to lose their money. They don't do valuations. And so here we are 20 years later, we hear the same thing, but they're just pointing that over to the crowdfunder side, who will learn very quickly the importance of valuation in these deals.
Do you think, could I make a comment on that? I wonder whether or not it's the kind of industry that you're actually going into. We just had, Harjeet, that would be much more tactful to raise my hand like that instead of jump in. But I just had a conversation with, a company that applied to us, which is really a CPG thing. And so she may not be quite ready for angels because she hasn't actually done some product market fit, and possibly that's where they might get a little bit more immediate feedback at a crowdfunder, WeFunder sort of thing, than she will get. She'd have to go to a lot of angels to get the same kind of feedback.
That's right. And Harjeet, what are your thoughts there?
So what I want to say this, look, to us living in North America, we have no idea how big is a crowdfunding market. Look at Europe. We're 10 years behind in the crowdfunding market, right? Look at Australia, look at China, look at India, right? The one thing, look at inventors, people who are inventing interesting devices, interesting products that are in the market. They're crowdfunding. We just call it product crowdfunding. We don't call it equity crowdfunding. They're building great businesses out there. They're just not angel backed, right? So they're raising money from the crowd as well. But if you compare the two, equity crowdfunding, product crowdfunding is almost like it's in billions of dollars, right? And so it's being raised. This is where equity crowdfunding, you like it or you do not like it. It's easy for you to just going to McDonald's and say, this is what you want to order. If you like a particular field, it's easier to spend, okay, I'm going to invest in cybersecurity transactions. These are the 10 companies on WeFunder, our crowd, or what have you, and I'm going to put in $1,000 each, right? It's becoming like a menu. And it all comes in how it's perceived, how much money is already in there. So I just want to make that point, like, yeah, in terms of compare the two, just look at Republic, what it has done, raised $100 million to go to the European market. Why? There's more money to be made in that market versus in America.
Good point. Any other closing comments on this? This is our last question. Anybody else have a thought there?
Yeah, so for most crowdfunding, I agree with what Robert said about it being feelings and so forth. And when Harjeet says, drop $1,000 across an asset class, it makes me squirm. It's just, I want due diligence to be done. So Harjeet, you have all this data. Tell me, as a group, the portfolio that is crowdfunding, what's their returns? Of all of the 24 million invested, what are the returns on that investment?
So think of this as an angel. When you invest into a company, what's your time period? 10 years, right? If you look at
10 to 15 years, yeah. No,
10 to 15 years. So crowdfunding regulation was passed in 2012, right? So I'm just going to put this out there. In $2,000 million, what can you really do with $1 million? It's, not many companies were opting out to raise money. As we are sitting in January of 2022, we're still 10 years in. Those statistics are not out there. I'm sure companies like King's Crowd and others will start tracking that, right? And all, you can correct me if I'm wrong, but those returns will come. But also, look, these are the people who don't have access to invest 20, 25, 30, 40, $50,000, right? When I agree with you in terms of due diligence, but also these people, they are saying, okay, this company has raised a lot of money. Look at from retail investors' point of view, right? How do you get access to Netflix and all of these deals? They're saying, okay, we get a deal in the public markets where everyone has made money, and you're telling us to live by, compare us to 10-year treasury, S&P 500, what have you, right in the public markets. and you're stopping us to invest into a company where we can make 100x on a deal. So just think about these risks, right? So it's a risk.
But the good ones that make 100x are not going to crowdfunding. And the ones that are going to crowdfunding are the ones that can't get their shit together. And so the sniff test that I have around crowdfunding is that the vast majority of them have not had, as Hall was saying, market reality applied to them. And that's in alignment with the people coming to my Startup Open Coffee who have not done meaningful customer development and discovery. And so they don't clearly understand what their market space is. And the taste of those two groups are the same to me. The probability that a random thing that I can pick on crowdfunding is going to return me positive, let alone 100x, feels very, very low, right? Way lower than my crappy angel percentage where I'm getting 10% of my deals are producing meaningful returns. And so somewhere in there, we have to introduce some grounding in the market realities and how the team is functioning, all the things we do in due diligence. And so I'm waiting for that conversation to begin over in crowdfunding. And I have not yet seen it, but I have seen the magic of marrying crowdfunding with angel investing, where we apply angel investing due diligence to a group and then use the audience of a company to fund and amplify that angel investing. I think there's a little magic sauce in that slice. I could not tell you what the search terms I would put on a crowdfunding platform that would produce that group of companies.
So just want to add before Charles jump in. Look, I agree with due diligence part and all of that. In my opinion, what are your characteristics of great crowdfunding company? That's a totally different discussion. A company that has a direct-to-consumer product, right, has a great Twitter following, they can raise money crowdfunding. If you're a B2B software, right, and if you can't sell your software and you can't sell your product to 1,000 or 2,000 VCs in America, then there's something wrong. So in my opinion, the companies that we really like, right, we like direct-to-consumer type of products. Like that's why when I say media and entertainment businesses, that's everyone, they allude to that we all consume content, different type of content. So that's when I, in terms of that type of conversation that you're trying to see, the we funders that are public, they take on all the junk, but then you have companies that take very specific deals, right? Like I am putting together a thing with one of the well-known family offices, only focus on, because media and entertainment is my interest, to only do this type of deal. Because why? Because we have invested close to $50 to $100 million. We're going to lead, but we're going to give access to the whole market to participate and vouch for us. So I just wanted to make that case. Sorry, Charles.
Oh,
Charles, you're the last one. We're going to close it after this. Go ahead, Charles.
Okay, well, I just want to say I was one of the guys who advocated and got the Jobs Act passed in 2012. And I was head of one of the industry trade organizations and on the executive board of the other. So I've been aware of this space and I still support it. I want to give you a pointer to a really good data source. Some of my colleagues from that era, Crowdfund Capital Advisors, CCA, they do a very comprehensive report on the status and the activity in the crowdfunding industry. And they're gung-ho bullish. I diverge from them in that I only invest in 1% of the companies that I see that has passed through the initial filter of an angel group or a platform. And so the other 99 are getting invested in through enthusiasm and emotion. That's fine, but that's like playing a video game. It's not professional investing as I think of it, but I'm still very passionate that the opportunity to participate, which is the major benefit of crowdfunding. And I just think it's terrible, the old system that only the rich could make money. So I'm in support of crowdfunding, but I don't do very much of it myself as a professional investor.
Great. Thanks, Charles. I want to thank everybody for joining today. We're at the end of our time. We'll be back next month with another series of topics. Thank you guys for joining us today. We will share the recording in the chat box with you guys. Wish we could go on longer, but we are out of time at this point. John, Harjeet, Catherine, Jigar, Richard, everybody, thank you guys for joining today. We're going to close it at this point.
Thank you guys.
Thank you,
so
Hall.
much.
Thank you very much.
Thank you. Bye-bye.